You know, most financial advice, it really boils down to one thing: building your net worth. It's this decades-long marathon of accumulation, with the promise of freedom somewhere way down the road. But what we're going to explore here is a different goal entirely. We're going to shift the focus from just building a number to generating cash flow that buys back your most precious, non-renewable asset, your time.
And that, right there, brings us to this really uncomfortable question that the traditional playbook seems to avoid. You save, you invest, you do all the right things, and then you ask this. And often, there's just silence. The conversation is always about how much will I have someday? But maybe the more important, more urgent question is, when do I get to stop selling my hours? This is the core problem we're going to unpack today.
So this really lays out the two core philosophies, doesn't it? On one side, you have deferred freedom. That's the standard path. Accumulate, 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 and hope for freedom at 65. It's all about optimizing for a specific number. But on the other side, you have time autonomy. Here, the goal is completely different. Generate meaningful cash flow today. Freedom isn't a date on the calendar, it's the moment your cash flow covers your life. You're optimizing for your time.
Okay, let's make this concrete. Let's talk about what I call the $500,000 problem. Imagine you've done everything right. You've managed to save up $500,000 and it's in a standard, safe 60-40 portfolio. Well, that portfolio is probably only spinning off about $1,000 a month in income you can actually use. Now, if your monthly expenses are $4,000, well, you're still completely tethered to a job. The net worth is there on paper, but the actual freedom, it's just not.
So here's how we're going to break this down. First, we're going to really dig into that time autonomy question. Then, we'll introduce a really critical framework called the sentiment spectrum. After that, we'll explore three very different paths for generating income: pure credit, trading upside, and balanced growth. And then we'll pull it all together to help you think about which path or what combination of paths might make sense.
All right, so the first big idea we need to wrap our heads around is something called the sentiment spectrum. The best way to think about this is as a scale. It organizes investments based on how much their success depends on human psychology, on the market's collective fear and greed. And what's really important to grasp is that some strategies are way more insulated from those moods than others.
And here's what that spectrum looks like. At the very top, the most dependent, you have pure growth stocks. Here, what people feel about the future is basically everything. A step down, you have dividend growth stocks. You're still a shareholder, so you're still highly exposed to market whims. In the middle, you get covered call funds with a more moderate dependence. And then all the way at the other end, the least dependent, you have pure credit. Here, a contract matters a whole lot more than a headline.
You know, this really reminds me of a powerful quote from the great Benjamin Graham. He said, "The investor's chief problem, and even his worst enemy, is likely to be himself." He understood this perfectly. Our own psychology, our tendency to panic sell or chase a bubble, that's often the biggest risk we face. And that's why this sentiment spectrum is so useful. Strategies that are less dependent on sentiment can act as a guardrail against our own worst impulses.
Okay, with that framework in mind, let's dive into our first path, the one that sits at the very bottom of that spectrum: pure credit. This approach is all about finding insulation from market psychology by focusing on contractual income. You're not trying to be an owner, you're positioning yourself as a lender.
And one of the main tools people use for this path is something called a closed-end fund, or a CEF. Just think of it like a publicly traded company, but its only business is owning things that pay interest, like corporate loans or bonds. And they often use a bit of leverage, a bit of borrowing, to help amplify the monthly checks they send out to investors.
Now, when you look at the numbers, the difference in cash flow is, well, it's pretty staggering. That traditional 60-40 portfolio we talked about with $500,000 might kick off about $12,500 a year. But a portfolio of these credit CEFs with the exact same amount of capital could generate $55,000. That's more than 4 times the cash flow. And that, well, that's the difference between a little extra pocket money and actual life-changing freedom.
But wait a second. An 11% yield? That immediately makes you ask, what's the catch, right? It has to, because there's no such thing as a free lunch in investing. So let's be really intellectually honest here and look at the potential downsides, because ignoring the risks would just be reckless. So here are the big ones. First, there's credit risk. It's simple. The companies you're lending to can go bust in default, especially if the economy hits a rough patch. Then there's leverage risk. That borrowing that boosts the yield, it's a double-edged sword that also magnifies losses. There's also the risk that the high payouts aren't sustainable and could get cut. And finally, a big one. This kind of income is usually taxed at your higher ordinary income rate, not the lower capital gains rate. That's a huge consideration. So, path number 2. This is where we start moving up that sentiment spectrum. This approach is all about making a very specific, very deliberate trade-off. You're agreeing to generate a high income today by systematically selling away your potential for future growth tomorrow.
And the way this usually works is through something called a covered call fund. The concept is pretty straightforward. The fund owns a portfolio of stocks, say the S&P 500, but then it sells call options against those stocks. Essentially, it's selling the right for someone else to buy those stocks if they go up to a certain price. In exchange for selling that potential upside, the fund collects a payment, a premium, and it passes that income on to you every month. The trade-offs here are crystal clear. The biggest one, of course, is that your upside is capped. When the market has one of those incredible bull runs, you're going to miss out on most of it. And on the flip side, while you get a small cushion, you are still exposed to most of the downside in a crash. Your income also really depends on market volatility, so it can go up and down. And just like the credit funds, the income is generally not very tax efficient.
Okay, so our third path is probably the one you've heard the most about. This is the most traditional income strategy. It's about being a shareholder, an equity owner, but specifically choosing companies that also have strong income-producing qualities. As you can guess, this sits much higher on that sentiment spectrum. We're talking, of course, about dividend growth stocks. These are shares in those big, mature, profitable companies that have a long track record of not just paying a dividend, but consistently raising it year after year. The goal here is a blend. You want both some current income and that long-term price appreciation. Now, it's crucial to remember, you're still an equity owner. Your portfolio's value is going to be very sensitive to market sentiment. The current yield is also a lot lower, maybe 3 or 4%, which often isn't enough on its own to reach time autonomy quickly. And dividends are never a guarantee. Even iconic companies have had to cut them in hard times. Really, this path is built for compounding over decades. It's not designed for high immediate income.
Okay, so we've walked through 3 very distinct approaches to generating income. Now comes the really important part, pulling all this together so you can start to think about what makes sense for you, for your goals, and for your own psychology.
This table really brings it all home. It just lays the trade-offs right out there, side by side. Just look at the current yield row. You see the high yields from credit and covered calls versus the lower yield from dividend stocks. But then look down at upside capture, and you see the relationship completely flip. It's the same with sentiment effect and tax efficiency. Each path is a unique bundle of compromises. There's no single best answer. There's only the best fit for you.
So let's circle all the way back to that original problem, that $500,000 traditional portfolio. This is the reality it produces, about $1,000 a month. I mean, for most of us, that doesn't really move the needle, does it? It doesn't buy you freedom, it doesn't reclaim your time. It's just not enough. Now look at this, the exact same capital, $500,000, but allocated to that pure credit strategy, the monthly income is now over $4,000. This is the aha moment. If your monthly expenses are, say, $4,000, this one strategic shift means you're financially independent. Your assets have now fully replaced your paycheck.
And that gets us back to the heart of this entire discussion. The gap between those two numbers, between $1,000 and $4,000, that isn't just more income. It's the difference between obligation and autonomy. It's the difference between having to sell your hours to live and choosing how you spend them. This is what time autonomy actually looks like. And so ultimately, this all comes back to a very personal question. The conventional path has you optimizing for a number, for net worth 30 or 40 years from now. The paths we've explored today are about optimizing for cash flow, for your time, starting now. Once you really see that this is a choice you can make, you can't unsee it. So the only question left to ask yourself is, which one are you optimizing for?